Chapter 11, we will be talking about depreciation, depletion, impairment, and disposal. So long-lived assets and cost allocation. We know that for the most part, still in the United States, we are accounting for our long-lived assets like our plant assets at their cost. And we use up those assets. So instead of expensing them in the year we buy them, we expense them over the time we use them up. And that is what depreciation is. It's not the change in value in the real world. It's taking what we paid for something that we're going to use for more than a year and expensing it over the time we're using it. We're getting benefit from it. The three terms all describe the same principle of allocating the cost of long-lived productive assets. Depreciation is just the word we use to describe the expensing of tangible assets that deteriorate over time, like property, plant, and equipment. Depletion is the expensing of natural resources. It's still expensing, we just call it depletion because it's dealing with natural resources. And then finally, amortization is the word we use to describe the expensing of intangible assets. So those assets we cannot see, and we'll be dealing with them more in the next chapter. So what do we need to know in order to calculate depreciation? Well, we definitely need to know the cost, and we've determined that in chapter 10. We spent a whole chapter discussing how we determine the asset's cost. Remember to review, it's all costs necessary to acquire and prepare the asset for its first use. We then have to define the service life, or how long we're going to use it, and that's really up to the company. It has to be reasonable. And then the residual value or salvage value. So we predict or try to determine the net amount we can expect from selling or disposing of the asset when we're finished using it. And if we know those three factors, two of which we decide on, and the other one, the cost, we already know how to determine, then we will be able to calculate depreciation. Now, we have to depreciate the asset, or in this case, they're still focusing on overall cost allocation. It has to be systematic. It should follow a formula. It should be rational. So the amount of depreciation expense each period should relate to decline in the asset's service potential each period, so how much we used of it. So what are the methods we use? Well, the first method, first of all, the depreciation base is what we will actually be expensing. And the depreciation cost or base is cost minus estimated residual value. That's how much we expense of the asset. We don't want to expense the part we think we're going to get back at the end. So we subtract it from the cost and for purposes of determining how much we can expense. Now there's different methods of allocating this cost or depreciating. There's time-based methods. One is straight line, we'll be looking at that. Another is an accelerated method where there's one or two or three of them. Sum of the year's digits is one, declining balance is another. And then there's an activity-based method called units of production. And this is appropriate if the service life is affected primarily by the amount the asset is used, but not by the passage of time. So if you can measure the usage in some unit of measure. And then there's the group or composite methods. So let's first take a look at straight line. Straight line is appropriate when a company estimates the service potential of the asset will decline by about the same amount. And really, in financial accounting, most companies use straight line to prepare financial statements. It's based on a formula. You've seen this before. It's the cost of the asset minus the estimated residual value over the service life, normally in terms of years. That will give you annual depreciation per year. It's the most widely used as. So let's take a look at an example. It's based on a formula. We have a Traub company. The asset cost is $120,000. Date of purchase is January 1, 2015. The residual value is $20,000. Its estimated service life is 5 years. It's also defining the service life of this asset in terms of hours of use, which we will use for another depreciation method. So this is just information about the asset. It's in your book as well, so you can follow along if you need to refer back. Let me find it. I don't have my book open. It is on. Oops. Oh. It is on page 11-4. So, to calculate straight line, remember it's a formula. We are calculating annual depreciation expense by taking the cost of the asset, $120,000, minus the residual value, what we expect to sell it for when we're finished using it or what it'll be worth, dividing it by the number of years we expect to use it, 5 years. So each year, the annual amount of depreciation, if the asset is used for the entire year, is $20,000. It remains constant over the life of the asset. Each year, we will debit depreciation expense and credit accumulated depreciation for that $20,000. That will cause the accumulated depreciation account, you could see next to the depreciation expense on this table, to increase by that $20,000 amount each year. Till the end of the life of the asset, the accumulated depreciation, or the total amount of depreciation taken, is $100,000. Each year, we can calculate the book value, which is really just the amount we see on the balance sheet for that asset, which is the cost of the asset, cost, minus accumulated depreciation. So the first year, accumulated depreciation is $20,000. 120 minus 20 is $100,000. If we go to 2019, take the 120 minus the $100,000 balance in accumulated depreciation, the book value is $20,000. Why is it at $20,000? Because when you are finished depreciating an asset, the book value should equal the residual value and never be less than the residual value. Never. The next methods we'll look at are accelerated methods. These get a little funky. I don't know who thought them up, but they are methods that could be used. They're called accelerated because we actually expense a large amount of the asset's cost in the beginning of the life of the asset. And as the asset gets older, we expense less than we normally would under straight line. It's an accepted method. Now, why do companies use it? And when is it appropriate? Well, when you use the asset a lot in the beginning of the life of the asset, when it's newer and it doesn't break down as much. You'll generate more revenue with it than you will when it's older. The first accelerated method is sum of the year's digits. It recognizes declining depreciation expense each year by applying a funky fraction. And here's how the fraction is looked at. We take how many more years can we depreciate this asset as of the beginning of the year we're calculating depreciation. And then we divide it by the sum of the years of the asset's service life. What does this mean? If it's a 5-year asset, we add the number 1 to the number 2 to the number 3, to the number 4, to the number 5. And that's our denominator. If it's a 10-year asset, you go through the same process. Add the number 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Add those numbers all up, and that's the denominator. What if you have a 30-year asset, though? Are you going to sit there counting on your fingers and adding these numbers all up? No. So we have a formula, and it is n meaning years of life, times n plus 1 divided by 2. For instance, that 5-year asset, we would take 5 years times 5 plus 1, n plus 1. So 5 times 6 is 30. 30 divided by 2, 30 is the numerator, 2 is in the denominator. 15 would be your answer, and that's what you would use in the bottom portion of this fraction. So let's take a look and see how this is calculated. We still use cost minus residual value for our depreciation base. Cost minus residual value. So 100,000, and that will remain constant over the life of the asset. We then multiply it by our fraction. Remember, the numerator of the fraction is the number of years you still can depreciate this asset as of the beginning of that year. Well, in the first year, we have 5 years to depreciate it. And we can calculate a full year's depreciation because the asset was purchased in January. So we take the number 5 in the numerator, and then we divide it by that 15 that we just calculated. The 15 remains the denominator throughout the entire life of that fraction. You can see in the table. So the first year, the depreciation expense for this asset is $33,333. That's also its accumulated amount, because now we have accumulated. Remember, we still do that same journal entry. Debit depreciation expense, credit accumulated depreciation. So the journal entry doesn't change. It's just the dollar amount will because of the different methods we have to choose from. Book value is still determined the same way. Cost of the asset minus the balance in accumulated depreciation. The first year, $86,667. So that's the amount this asset will be reported on the balance sheet at if they use some of the year's digits to depreciate instead of straight line, and they have a choice. The second year, we'll do the same type of calculation. You take the 100,000 depreciation base, multiply it by, remember, we ask ourselves, how many more years can we depreciate this as of the beginning of 2016? Well, all of 16, 17, 18, 19. So there's 4 years left to calculate depreciation as of the beginning of this year. Divide that by your denominator, which remains constant, 15, 26,667. Accumulated depreciation will increase by this year's depreciation amount, and the book value is 120 minus the 60 in accumulated, which will also be 60. The next year, take the 100,000 times the 3 years remaining to calculate depreciation divided by 15, $20,000. That will increase your accumulated because you'll still do your journal entry at the end of the year. And book value will now be at 40,000. Remember, one more time, that's cost 120 minus the 80,000 in accumulated depreciation. 2018, our fraction will be 2 years over 15 because you could calculate depreciation for 2018 and 19 yet. And you can see your calculations and your dollar amounts. And in the final year, you'll use 1/15. 100,000 times 1/15 equals 6667. Your accumulated will then increase to 100,000. Book value will equal residual value. So that is the sum of the year's digits method. Our next method in the accelerated depreciation methods is called declining balance. This is a little different. It does recognize a declining depreciation expense amount each period by applying a constant rate. So we're going to be multiplying something by a constant rate. And that something is book value, not depreciable base. So in the straight line and some of the year's digits, we always use cost minus residual value in our calculation. That is not the case with declining balance. We use book value, which is cost minus accumulated depreciation. So you have to keep that straight. Let's take a look. The declining balance depreciation rate is some multiple of the straight line rate. What does that mean? Declining balance rate equals M. So whatever your rate is times the straight line rate. The multiple M is often 2, so you'll hear it referred to as double declining balance. What that means is we take the number 2 times the number 1 over the life of the asset. 1 over the life is the straight line rate. That would give us a fraction of 2 over the life of the asset. But you may also hear it referred to as 150% declining rate. In that case, instead of using 2 times 1 over the life, you would use 1.5 times 1 over the life of the asset. So you do have a choice there. So let's do take a look at the information from Troop Company's purchase of the equipment, I'm assuming some asset, and under double declining and one under for 50% declining. In 2015, as of the beginning of that year, we say, what's the book value of this asset? Remember, book value is cost minus accumulated depreciation. Well, the cost is $120,000. There is no accumulated depreciation yet. So that will be the dollar amount you will use to calculate $120,000 times the rate. Well, where did this 40% come from? Double declining balance, we take the number 2 times 1 over the life of the asset, which is 5 years, which is 2/5. 2/5 converts to 40%. So each year we will use 40% to depreciate the book value as of the beginning of the year. So in 2015, $48,000 is your depreciation expense. You'll put that number into your journal entry. This would cause accumulated depreciation now to be at $48,000. New book value as of the end of the first year is $120,000 minus $48,000, or $72,000. End of the first year is the beginning of the second year. The next year, we'll use the new book value of $72,000 times the rate of 40% to get depreciation expense in year 2 of $28,800. We will use that dollar amount in our journal entry at the end of year 2. Debit depreciation expense, credit accumulated depreciation for the $28,800. If you do a T account while we're working on this and keep adding that accumulated depreciation into the accumulated depreciation's T account, the new balance at the end of year 2 will be $76,800. Cost $120 minus $76,800 will give us a new book value of $43,200. And that will be the book value we use to calculate the third year's depreciation times 40%, $17,280. That will increase our accumulated depreciation to $94,080, causing our book value, $120 minus $94,080, to be $25,920 at the end of year 3. In year 4, if you're going, what happened? Why isn't the 40% there? Well, if we take the book value of $25,920 and multiply it by 40%, that will give us $10,368. If we used that dollar amount in our journal entry, our accumulated depreciation would increase to $104,448. That being subtracted from the cost would leave us with a book value less than the residual value. Book value then would have been $15,552. Residual value is $20. We can't have book value ever be less than residual value. So if your calculation causes you to record too much depreciation, you don't use the calculation amount. You only record enough depreciation expense. So when you take your cost minus accumulated, it equals the residual value. Book equals residual. So in year 4, we plug it, 5920. That will give us accumulated depreciation of 100, causing our book value to be at 20. And in the 5th year, we don't calculate any depreciation. We've expensed all the cost that we can. The second method under declining balance is the same exact thing, except we don't use 2 times 1 over 5 or 1 over the life. We use 1.5 times 1 over 5. So if you take 1.5 divided by 5, your percentage is 30%. So you're still going to do the calculation the same way, it's just a different rate. And because the rate is lower, your depreciation expense will carry into the last year. So if we take 28,812, the book value at the end of year 4 times 30%, we only get depreciation of 8644. That's not enough. Our calculation causes us not to record enough in that last year of the life of the asset. So we have to record enough at the end of the life of the asset, even if our calculation is less. So that book value equals residual value. Okay, so that's the declining balance methods. The next method is the activity method. So when the service life of the asset could be measured primarily by use instead of passage of time like years, we can use this method. The activity is usage is measured in terms of some input or output, hours, the number of miles driven, the number of units produced, the amount of input put in. We saw and on page 11-4, this asset's life could be defined in terms of hours of use. So they said if we're using a straight line or a declining balance method, use 5 years. But if you're using activity-based, this thing will be used for 10,000 hours. So the first thing we must calculate is what we call a depreciation amount per unit. In this case, it's hours, so it would be how much does this depreciate or depreciation rate per hour? How do we find that? We take the cost minus residual and divide it by the life in terms of total hours it will be used, total miles it will be driven over its life, total number of coffee cups that machine will make. Okay, and in this case it's 10,000 hours, so $10 per hour. So each hour this machine is used, it depreciates $10. So all we need to know to calculate the depreciation is the actual number of hours it was used each year. Now remember, you can only calculate depreciation up to the point you use it 10,000 hours. And I don't want you to think that, because I know when we're in theory worlds, we think, oh, what happens at the end of 5 years or 10,000 hours? Do we just stop using it? No, we estimated that. We keep using it. We just stop recording depreciation expense, and that's okay. There's no depreciation police. Okay, we estimated 10,000 hours. Hey, if we could use it for 12, we're going to keep using it. We just stop doing these calculations. We base our calculations on our estimate. Now, and if you're going, well, can you change your estimate? Yes, you can. We're going to see that in a few minutes. So we take 2,100 hours times $10 an hour. 21,000 is the amount of depreciation expense for the first year. You calculate your accumulated the same way. Just add it in when you add more depreciation, because the journal entry would cause it to be posted to that account. And book value is cost minus accumulated depreciation. The next year, use the number of hours in 2016, 2,500 times $10 an hour. 25,000 is your total. And you would do the same for each year. Now, this machine, it was used 2,100 the first year, plus 2,500 the second year, 2,300 the third year, and 1,800 the fourth year. So far, it's been used. Wait, I didn't do that right. Hold on. Okay, give me 1 second. I got alarms going off. Okay, try that again. So 2,100, come on, the first year, 2,500 the second year, 2,300 the third year, 1,800 the fourth year, or a total of 8,700 hours. Now, normally we would have all the hours. So what they're saying here is, since we're only calculating it up through that fifth year, if we only use the 1,000 hours, we would only account for 9,700 hours. In the real world, we say we use it for 1,000 hours in year 5. 1,000 times 10 would be $10,000. Then year 6, we'll use it 300 hours times $10. But in theory here, they're just forcing us to calculate enough depreciation expense in the last year so that residual value equals book value. I'm not too thrilled about that, but that's how the author discusses it. So in recording depreciation, regardless of the method, remember the amount of depreciation is generally recorded each period by debiting depreciation expense and crediting that contra asset accumulated depreciation. Okay, so the accounts remain the same. The dollar amount depends on the method you use. It's normally reported as a current period expense, and that's all you really need to know. Regardless depreciation method used, it's generally recorded each period of the asset's service life by making that journal entry. Doesn't matter. Okay, so we've talked about this. Sorry, I guess I'm saying things I shouldn't, but depreciation is just what we said, a process of cost allocation. It's not valuing the asset. It's just taking what you paid for an asset and expensing it over the time you're using it, instead of all in one accounting year. The asset's book value should represent fair value both at the time the asset is acquired and at the end. Other than that, it doesn't. Okay, and you gotta love graphs, right? Graphs are showing you how depreciation expense under each of the methods, how they would differ. So straight line gets its name because look at, it's the same amount each year, no matter what. So it's a straight line. But double declining balance and some of the year's digits, they expense a real lot in the beginning of the life of the asset, and then less, and even, lower than straight line as the asset gets older. The book value graph shows you that no matter which method you use, okay, it doesn't matter. Your book value will always be the same when the asset is finished being depreciated. It's just the timing. Double declining balance, a real lot in the beginning, less as it gets older. Same with some of the year's digits. Straight line, same amount every year. So it's a timing issue. Two additional factors that are considered when a company selects depreciation is the amount of maintenance and repair costs and risk associated with cash flows from the asset. Okay, so total maintenance, total depreciation and maintenance in one instant. Take a look at this. Okay. So if your maintenance stays the same, you should do straight line. If your maintenance increases over time as you use the asset, you should use an accelerated method. And we talked about that. Okay. The depreciation of property, plant, and equipment may lead to distortion in the rate of return analysis of on the assets. So we determine rate of return on the value of our assets by taking net income divided by the book value of the assets. So we're just pointing that out. Another type of depreciation method is group or composite. Group depreciation is applied to homogeneous assets that are expected to have similar service lives and residual values, like laptop computers. Composite is applied to heterogeneous assets that are related but in group depreciation, a company, when it owns a group of homogeneous assets with similar ages, useful lives, and residual values, they could capitalize the total cost of the assets into one account and treat it as one asset for purposes of depreciation instead of separate ones, and then base the group depreciation rate on the average life. So we calculate depreciation expense each period by multiplying this rate by the balance in the asset account. And we accumulate the depreciation in one contra account. Example. Mineola Company purchases 10 cars for $20,000 each, and the average expected service life is 3 years, residual value of $5,000 each. Of these cars, three are sold after 2 years for $8,000, 5 after 3 years for $6,000, and 2 after 4 years for $4,800. How will they compute depreciation? Cost minus residual value divided by life. So 200,000 minus 50,000, because each car is a $5,000, I'm sorry, 20,000, residual value 5,000. Okay, and divide that by 3. So 50,000. 50,000 divided by 200 is 25% of the cost of the assets. In item 4, hopefully you heard my explanation on 1, 2, and 3, but you can pretty much figure that out. We calculated that. When they dispose of 3 cars at the end of the second year for $8,000 each, well, 8,000 times 3, they're getting cash of $24,000. They're getting rid of 3 cars that cost $20,000 each, so we're going to credit the cars $60,000. And then $36,000 is calculated, as you can see in A below. The adjustment to accumulated depreciation is the difference between the cost of the cars and the cash received from disposal. No gain or loss is recognized at this point. So when you're using a group depreciation method, that's how you journalize the disposal of the cars. Hopefully, I'm going to say this again. I'm sorry, I fast forward and I think I lost my recording, so I'm going to do it again. In the third year, depreciation expense isn't based on $200,000 of cost of the cars because you sold 3 of them that cost a total of $60,000. So $140,000 times 25% is the amount of depreciation. When you sell 5 cars at the end of year 3, you'll take the $6,000 you sold them for times 5 is $30,000. Remove 5 cars that cost $20,000 each, or $100,000. The difference is debited to accumulated depreciation. To record the depreciation expense for the 4th year, the disposal of 2 cars at the end of the 4th year for $4,800 each, and the net gain or loss on the entire group. Well, look at little b. Because assets are not depreciated below their residual value, the depreciation expense in the last year is the amount needed to reduce the $11,000 per car book value, or the $40,000 remaining cost, minus $29,000 in accumulated depreciation. So we only want to record enough depreciation So that cost minus residual will equal 10,000, or I'm sorry, cost minus accumulated depreciation will give us 10,000. Right now the book value is at 11. We need it to be at 10, so $1,000. So we will debit cash for $9,600, the amount received, credit the CARS account for the 20,000 times 2, only debit accumulated depreciation to bring it to a balance of 0. Okay. And finally, we can report a gain or a loss on the sales. So we handle it a little differently than a normal sale when you're using group depreciation and you sell an asset out of that group. Composite. A company may apply composite depreciation to heterogeneous dissimilar assets that are related but have different service lives or residual values. It follows a similar procedure to group. It combines the assets in one account and depreciates them accordingly. It uses one accumulated depreciation account, just like we saw, and it doesn't recognize a gain or loss on each item retired. It recognizes an overall gain or loss when it retires the final asset. So here's an example of composite 3 assets, 25, 13, and 12. There's their residual values and their lives. Okay, their depreciation rate. So the annual depreciation for each asset would equal a total of 7,000. So cost minus residual divided by life. Cost minus residual divided by life. Okay, 7,000. Take the 7,000 over the total cost of the assets of 50,000. The depreciation rate is 14%. Depreciation will be computed by taking 14% by the cost of the assets remaining in service until the book value equals the estimated total residual value of 6,000. GAAP requires the following disclosures for depreciation. So we've seen a couple different methods here. So when we choose one, we have to tell the depreciation expense for the period, balances of major classes by nature or function, accumulated depreciation by those major classes or function, a general description of the method or methods used in calculating the dollar amounts, and there's an example of Panera breads. And this is very standard and normal, so you could take a read through. It's in your book as well. You could see the various assets they have in property, plants, and equipment, the overall total accumulated depreciation, and the book value for 2013 and 12. And that would be reflected on their balance sheet. You also see the lives that are used, and it looks like straight line is their method. Leasehold uses straight line. So that's what they're using. So you could take a look through these questions. I'm going to keep moving along. Here are some additional issues we need to worry about when it comes to depreciation. It's been pretty standard, our depreciation. This asset was purchased in January, used the entire first year, and we were able to calculate depreciation each year for a total of 12 months. That's one. None of the estimates changed on that asset. But what if they do? Let's take a look. So what if we buy an asset in March in the first year? Partial periods, it's called. What if we need to change or correct depreciation? Depreciation and accretion of asset retirement obligations. So let's take a look. Partial periods. What happens when we buy it during the first year, in maybe the middle of the year, the end of the year, it doesn't matter, but we don't buy it in January in the first few days, or we sell it during the year? Well, when acquisition and disposals occur throughout the year, we only record depreciation related to the portion of the year the asset was in operation. While depreciation could be computed to the nearest day, it's unnecessary. It's really immaterial. we have three common alternatives or conventions we use to compute depreciation for partial periods. The nearest whole month, nearest whole year, or we could use a half-year convention. We assume we bought it or we sold it in the middle of the year. So let's say Van Company purchases a 6,000 asset with 3-year life, no residual value on August 18th. If they use the whole month to calculate depreciation and they use straight line, they're going to take the 3,000 or 6,000 cost minus residual, there is no residual, divided by the life of 3 years. So the annual amount of depreciation when they use the asset for 12 months will be $2,000. But in this first year, they bought it late August and they say, okay, go to the next fullest month. So they used it all September, October, November, and December, or 4 of the 12 months. So in that first year of use, the first year they're recording depreciation, they're only recording 4 months of depreciation, or $667. The next fiscal year, they'll record a full 12 months. Same with the third year. But in the fourth year, they record 8 months. So we're not saying just record depreciation for 3 accounting periods, but 3 years of use. So we're actually going into 4 accounting periods because in that last year, they have to record the remaining 8 months of the asset's use. This is fun. Some of the year's digits. This is crazy. I'm going to show you an easier way, and I'm going to have to talk you through it. What if instead of using straight line, they use some of the year's digits? Remember that? Okay, this is a 3-year life of an asset. So we take the depreciable base, which would be 6,000 minus residual, which is 0, and we're going to multiply it by, remember in our formula, the first, what we do is we ask ourselves, how many more years can we depreciate this asset? Right? And that would be as of the beginning of the first year, which really starts in the beginning of September, 3 months. Okay? Or 3 years, I'm sorry, 3 years. And then we divide it by 1 plus 2 plus 3. Remember, we add up the sum of the digits that make up the life. The 1 plus the 2 plus the 3, which is very easy, and that's 6, right? So the amount of depreciation expense for the entire first year is $3,000. But we don't want an entire year's depreciation. We only want 4 of the 12 months in that first fiscal year. The first one, because we bought it in August, or $1,000. So what happens the next year? Well, this is where it gets funky, okay? You could see there that in year 2, they go, okay, years 1, using 3/6 as your fraction, you can expense an entire $3,000. You only expense 4/12 of it in that first fiscal year. Going into the second year where you're using it for a full 12 months, you have to expense the other $2,000 of that, or 8/12 of the $3,000. But that only accounts for 8 months of the 12. So now, how do you calculate your second year's full year of depreciation? 6,000 times 2/6. It's crazy. And then take 4/12 of that. You could ignore that and do this instead. As of the end of the first fiscal year, you have depreciated this thing 4/12, right? 4/12. 4 divided by 12, or 0.33. Right? 1/3 of the asset's life. So at the beginning of fiscal year 2, you can still depreciate this 2.67 years. You've only depreciated it 0.33 so far. So in your numerator, you will take 2.67 and divide that by 6. That'll be your fraction for the beginning of fiscal year number 2. Take the 6,000 times 2.67 divided by 6. And you get $2,670. With that calculation they're doing on our screen in front of us, it's $26.67. We're off by $3. That's immaterial. Okay, so you can do it the way they're showing you on the slide here, or you could do it the way I was just telling you. Once you figure out that 2.67, now at the beginning of the 3rd fiscal year, you're going to take cost minus residual 6,000 times how much more do I have to depreciate this? 1.67 years divided by 6. It just makes your calculations so much easier. If you take that times 6,000, you're going to get $1,670. So in the final year, you only are depreciating this in the fiscal year 4, 6,000 times 0.67 divided by 6, and you'll get $670 or somewhere around that. Let me see. 0.67 times 6. What? Oh, 0.67 divided by 6 times 6,000. $670. So it's up to you the route you want to take. I just find it easier to stick with that rule. How much did I depreciate it as of the beginning of this year? I only depreciated it 0.33% of the life. I'll subtract that from the total life of the asset, and that's how much more I have to depreciate to figure out that numerator. If you're using double declining balance, again, you don't have to do what they're doing here. You could take 4,000 minus, or you could take your $6,000 asset times the normal route, double declining balance, it would be 2 over 3 or 0.67. You would get 4,020 as the amount of depreciation for the first year. But that's for an entire 12 months. You only want to know 4 of 12. So take the 4,020 divided by 12 times 4. And you get $1,340, which is very close and would be acceptable. Then you don't have to do any of this other calculation here. What you would say then is, okay, what's my new book value as of the beginning of year 2? 6,000 minus 1,340 in depreciation you just took, 4,660. Multiply that by 2/3. Depreciation, 3,122. So you might be off a couple bucks, but it's a different way of doing the depreciation and following more in line with what we talked about when we looked at these methods overall. If you have any questions on that, please let me know. If you decide to use a half-year convention, you apply the half-year convention the first year you buy it and then in the last year or when you sell it. You assume you bought your asset the middle of the year, no matter when you bought it, and you assume you sold it or in the last year of the asset's life, you used it for 6 months. So the annual depreciation straight line would be 2,000. We assume, even though we bought it in August, we bought it in the middle of the year, so we would take 1/2. And here's a demonstration using some of the year's digits with that same idea. Remember, in the first year, you could say 6,000 times 3 over 6 times 1/2 will give you 1,500. Going into the second year, you'll say 6,000 times how much longer can you depreciate this? 2.5 years over 6, and that will give you 2,500 instead of figuring out 6,000 times. I could depreciate this 2.5 more years divided by 6, and you'll get 2,500, and you don't have to worry about keeping track of stuff. And there's double declining balance. Again, the same method as we used before. It's just that now instead of going 4/12, you're using 1/2 because the assumption is you bought it in the middle of the year. What happens if a depreciation estimate changes? Well, you could change, remember, two things we estimate, service life and residual value. And you can change these. If something changes with regards to the asset, it's okay to revise your estimates. Can't revise cost necessarily, but the estimates you can. And what we do is we change them prospectively. What does this mean? We find out what the book value is when we want to change the estimate and then revise the depreciation calculation based on the new estimates. Kelman Company bought a machine for $200,000. At that time, they estimated they would use it for 10 years and it will have a residual value of $20,000. It uses straight line at a rate of $18,000 per year. On January 1, so this is 5 years later, when the machine had a book value of $110,000, so cost minus accumulated was at $110,000. They said, "Oh geez, you know what? We're only going to use that 4 more years and its residual value is changing to $10,000." When you calculate depreciation going forward, you'll use the book value at the beginning of the year as the new cost. 110,000 minus 10,000 new residual value divided by new remaining life of 4 years. So 25,000 would be the new depreciation amount for 16, 17, 18, and 19. So that's how you do it with changes. A change for currently owned assets is also accounted for prospectively if you want to change the method, and you need a justifiable reason. So if you want to go from straight line to double declining balance. What you do again is you determine the book value as of the beginning of the year and calculate under the new depreciation method. The change is called a change in accounting estimate that is affected by a change in accounting principle. What happens if you have an error? We account for it as a prior period adjustment, meaning the effect on the current period's financial statements involves a correction of the amount in the accumulated depreciation account. So if your depreciation amount is incorrect, your accumulated depreciation account is wrong, and you either didn't record enough depreciation expense in a prior year or too much, so retained earnings would be off because you close your prior year expense accounts to retained earnings. So a company's previous financial statements are also corrected. The acquisition and use of operating assets may create an asset retirement obligation, which is a legal obligation related to the retirement of an asset. The fair value of this obligation is initially recognized as a liability, with an offsetting increase in the carrying value of the related asset. This is it's not something that always happens. In subsequent periods, the asset is depreciated over its service life. The company recognizes accretion expense and increases the asset retirement obligation each year it uses the asset. What is accretion expense? It's classified as an operating expense and results from the increase in the amount of the liability associated with the asset retirement obligation. It is computed by multiplying book value of the liability by a discount rate, so a percentage, used in computing the original present value of that asset retirement obligation. You need an example, right? January 1, Reed Company spent $100,000 in the interior redesign of a retail store which it had acquired through a 10-year lease. They recognized a $12,000 asset retirement obligation related to this leasehold improvement. Reed depreciates this asset over 10 years using straight line, so $112,000 is the depreciation expense, because it would be the 100,000 plus the 12,000 asset retirement obligation, and record that as depreciation. In addition, Reed must recognize the increase in the present value as accretion expense. If the discount rate is 10%, they would take the 12,000 obligation times 10% and record that as 1,200 and credit the liability asset retirement obligation. Impairment of assets can also occur. So property, plant, and equipment is valued at its historical cost minus accumulated depreciation. And normally the real world value, or the fair value of those assets, may increase over time. Because depreciation is allocated and doesn't attempt to measure fair value, there could be situations, though, where that asset's real world value is even lower than its book value. If that occurs, we call it an impairment. We shouldn't record it at its book value, but at some lower value. So we've lost usefulness of this asset because of the decrease in fair value of it. So how do we account for that? Well, GAAP requires the company review its property, plant, and equipment for impairment whenever there's an event or circumstance that might indicate some of the book value may not be recoverable. Some examples of when this would happen: significant decrease in the fair value of the asset, change in the way the asset is used, doesn't have that usefulness anymore, a change in business or regulatory environment. There might be a law that says you can't use that asset anymore, or you've got to decrease the use of it. Cost of constructing exceeds the planned amount. So you can see there's many, many different reasons. Okay, companies are required to review and see if these exist. And if the book value of the asset is not recoverable, the impairment loss is measured and recognized. How do we do that? We first do a recoverability test, and this is important. It's a two-part test. What do we do here? To test for impairment, a company first groups the assets at the lowest level at which identifiable cash flows are largely independent of the cash flows of other groups of assets. A company estimates then the future net cash flows they expect to get from the use of the asset and its sale. So just, drop bottom. How much cash are we going to make using this asset, and how much can we sell it for? If the total expected cash flows, so if that amount added together is less than the book value is not recoverable and there's an impairment. Now, you just don't subtract that from the book value to get the impairment loss. Nope. That's just to determine if there's an impairment. How do we calculate the impairment? If the recoverability test indicates an impairment has occurred, the impairment loss for an asset that the company intends to hold, so we're still going to use it, is measured between the asset's book value and its fair value. What is fair value? The amount at which the asset could be sold right now into the market. Okay. If we don't have a market, then take a look. January 1st, Hall Company purchases machinery for $3 million. It held it for use and not for sale. It's depreciating it over 10 years. Late in 2016, due to technological changes, in the industry and reduce selling prices for its products, Hall believes the machine has become impaired and will have a remaining useful life of 5 years. To test for impairment, they estimate that it will produce cash flows of $300,000 each year for the next 5 years. In addition, Hall uses a discount rate of 16% to evaluate any kind of capital budgeting projects. So purchases of assets that are similar to this with similar risk. So Hall will test for impairment as follows. First, the machine costs $3 million. They've depreciated it for 4 years and an annual depreciation amount of $300,000, which would be $1.2 million in accumulated depreciation. So the book value of the asset right now is $1.8. They expect to make $300,000 a year for 5 more years, or $1.5 million. Because the 1.5 is less than 1.8, there's an impairment. But how do we measure that impairment? Well, if they came out and said the market value of this is 1.2 million, you would just subtract and you would make the 1.2 million your new book value of that asset, and you would have a 600,000 impairment loss. But because there is no going market, we will take that 300,000 a year and discount it back to today's dollars. So we'll use present value of an ordinary annuity, because these are 300,000 per year. It's not a one-shot deal. And interest rate is 16%, periods are 5. So your factor would be 3.274294. You make sure you could find that on table 4. 300,000 times that. So the present value of that 300,000 we're going to make over the next 5 years is really only 982,288. So that's the fair value of the equipment. So we would subtract that from the book value and get an impairment loss of 817,712, and that is recorded as a loss on our financial statements. And there's the journal entry. You would debit loss on impairment and you would credit the accumulated depreciation account for that loss. That will then bring the book value of the asset down to its market value of 982,288, and then that would be the new cost you would use to calculate the remaining 5 years of life for depreciation purposes. When you're going to sell an asset and have an impairment on it, it's reported at the lower of its book value or fair value minus any costs to sell it. Okay, and so that's the difference between that and what we just did. If there's a restoration of impairment loss, it's permitted if the net realizable value increases when you're selling an asset. In this case, a company would recognize a gain to the extent of previously recognized losses. However, it can never be revalued above its original carrying value. So you can't make it worth more than it actually was. There's a great chart to show you how we test for impairment, and if we have the recoverability test, if cash flows are greater than book value, there's no impairment. If cash flows are less than book value, then the next question is, are we holding it or are we selling it? If we're selling it, net realizable value minus book value will be your loss. You can restore impairments if it's held for sale. If it's held to be used, it's fair value minus book value. There's no restoration of any of the impairment loss because you're still using it. This is why do we do impairments? It's just to make the financial statements better, more reflective of fair value when fair value is less than what we're carrying the assets at. And this is just some more information you could read through. I'm getting so how about disposing of an asset? We can get rid of it, sell it, throw it away, whatever. exchange it. When a disposal occurs, a company will recognize normally a gain or a loss, and the gain or a loss is the amount that they received minus book value. Its gain or loss are listed in other income and expense category in continuing operations. Or it could be, disposition of a discontinued operation. Remember that? The company first records, this is important, you must first record all depreciation on the item being disposed as of the date of disposal, and then remove the cost of the asset, any accumulated depreciation related to the asset. Take a look. Bean Company as a machine that originally cost $10,000 has accumulated depreciation of $7 at the beginning of the current year and is being depreciated at $1,000 per year. The company sells the machine September 30th for $1,200. Now the first step is update depreciation for the year. If you haven't recorded any depreciation from January 1 through September 30th of this year, you got to record that first because you've used that machine for the 9 months. So take 7,000 times 9/12. Depreciation expense increased $750. Accumulated depreciation is increased $750. Then, the accumulated depreciation at the beginning of the year was $7,000. You just added $750 to it. You got to keep that in mind. You could record the amount of cash received, debit cash. Remove the asset next. Remember, you have to remove the total cost of the asset out of the machine account by crediting it, and the total amount of accumulated depreciation related to the asset that you just sold, $77.50, by debiting it. The difference will either be a gain or a loss. So the book value of this asset was $22.50. Do you think I could do that in my head? Isn't that awful? Yes, $22.50. So we should have gotten cash of at least $22.50. We didn't. We only got $1,200. So we gave up something we should have got $22.50 for. We only got $1,200, so we took a loss of $1,050, and we would debit loss on disposal. If we received more than $22.50, we would have credited gain on disposal. Okay. Impairment and disposal disclosures must be made in the summary of significant accounting policies. There's McDonald's. And you could answer some questions about that. Okay. I'm not really going to go into depletion. We don't have any assignments related to it, I don't believe. It's very similar to straight line depreciation. It's just that it's dealing with natural resources, timber, coal deposits, oil and gas. When an asset is purchased for natural resource purposes, it is identified as an asset. And then as it's excavated, it is depleted or expensed. So the allocation of the cost of a natural resource to the periods in which benefits are received. So the cost of an asset, bring it to any expenditure to obtain the rights to the natural resource and bring it to a condition in which it can be used, is capitalized. It's debited as an asset called natural resources. These include acquisition costs, exploration cost, development costs, and restoration, how much it's going to cost at the end to bring it back to its original state. So all these costs are included as natural resource costs. Computing depreciation is very straightforward. It's an activity method. What we do is we take the cost we determined from the last slide minus the residual value, and we divide it by how many units of whatever we're excavating we're going to make on it, how much we're going to take out. Once we have that amount, we take how much we actually recovered each year times that depletion rate, and that's how we expense the natural resource. Quick example, Reggio Company purchases land for $3 million, from which it expects to extract 1 million tons of coal. The estimated residual value is $200,000, and it mines 80,000 tons in a year, the first year. Take the 3 million minus 200,000, cost of the natural resource minus 200,000, divided by the 1 million tons it expects to extract. $2.80 per ton is how much the depletion is. 80,000 tons was depleted in the first year times $2.80, so 224,000. Because they're selling this coal, they'll debit inventory 224,000 and credit, that's how much it cost basically, and credit the coal mine 224,000. Okay, and then here's another example. Like I said, I just wanted to introduce it to you a little bit. We are not going to go into depreciation for income tax purposes. You can take a look at that. You'll learn all about it in income taxes. But if you already had taxes, you can make sure you take a look through and learn all about the tax depreciation in our tax system over the years. What's important to know is that the new tax law that just went through does not affect depreciation as the way we do the major calculations. MAKERS is still our way of doing depreciation.